Good afternoon, everyone. So this is going to be a joint presentation with Leo on economic policy and a watching brief on inflation. But first of all, I would like to thank the organizers for inviting us to this really stimulating and thought-provoking event, and congratulate you on organizing it. So the objective of economic policy is to increase living standards and the well-being of the people in a country. And there are four channels through which higher living standards and well-being can be achieved. And the first channel is macroeconomic stabilization. So the idea here is to reduce output fluctuations or output volatility and business cycle fluctuations. The second channel through which we can achieve higher living standards and well-being is through lifting productive capacity. So the idea here is to have productive government expenditure that leads to more private sector investment and increases in productivity, and to have a tax system that generates revenue in a fair and equitable way. The third channel for lifting productivity, for lifting well-being and living standards is through equitable distribution. So the idea here is to distribute resources, wealth, and income according to what people consider fair. And the fourth channel is to provide a safety net. So to have some minimum protection and security provided to people who are in need and when they need support. There are three main policy tools. The first tool for supporting well-being and increases in living standards is monetary policy aimed at price stability. Okay. Okay, thank you. The second policy tool is fiscal policy. So the reference here is to the use of public finance instruments. So this includes government spending, revenue generation, and the management of the government's balance sheet. And the third policy tool is regulation, which is really fundamental for markets and societies to function. And so regulation is used to ensure competition, fair trade, accurate information in the marketplace, to protect the rights of consumers and the safety of residents, and to safeguard the environment. So the COVID-19 pandemic has severely impacted on people's living standards and well-being. The COVID-19 shock is unusual and different from the shocks that the economy usually experiences, because it's an uncertainty shock. We don't know how long the pandemic is going to last, and we don't know how the economy will adjust, or it has started to adjust in response to this shock. And so because it's an uncertainty shock, consumption has fallen and savings has increased because of uncertain employment and income prospects. But also productive capacity has declined because of supply disruptions and because of delayed uncertainty by businesses in response to the uncertainty. The pandemic is also unusual in that it has led to unprecedented policy actions. And these policy actions have had at least 4 consequences, which I will spend the rest of my time talking about. So first consequence in terms of the policy responses is with respect to monetary and fiscal policy. So the Reserve Bank of New Zealand currently does not adjust the policy rate to change monetary policy. So the policy rate, the overnight cash rate, or OCR, is near zero. So the Reserve Bank could have continued to influence interest rates by using the derivative, interest rate derivative market. But instead, the Reserve Bank has started to purchase government bonds and local government funding agency bonds in the secondary market. And the Reserve Bank pays for these bond purchases by crediting settlement account balances that are held at the RBNZ by settlers' banks. And so these large-scale asset purchases have increased seniorage. So seniorage are the profits that the Reserve Bank makes from issuing central bank money. And the increase in seniorage has also increased the government's funding, because the government is the beneficial owner of the central bank. So most of the profits from the Reserve Bank are paid to the government in the form of dividends. And so these large-scale asset purchases have increased government's borrowing, but without increasing the Crown's indebtedness, because most of the debt issued by the government is held by the central bank. The Reserve Bank has also undertaken a funding for lending program, under which it lends to eligible banks at below market interest rates. And so because of these two facts, that the central bank is currently providing substantial funding to the government and also engages in concessional lending, the central bank effectively has become a fiscal agent. And the implication of this is that we can no longer, at the moment, independently specify monetary and fiscal policy. The second consequence, so financial reporting is essential for sound economic management or management in general. And so to conduct sound economic management, we need comprehensive public sector financial information, which we currently do not have. So the financial statements for the government, which are produced by Treasury, they don't include local government. And the government finance statistics, which are produced by Statistics New Zealand, do not include public corporations, which most importantly includes the central bank. Also, to reassure markets of the operational independence of the central bank, we need transparent reporting about the fiscal and quasi-fiscal transactions that are currently being undertaken by the central bank. We need to report consolidated public debt, both excluding and including the Reserve Bank settlement cash. So excluding it because central bank money is irredeemable. So in fact, it is a liability in name only. And including the Reserve Bank settlement cash because total liability is what affects the government's ability to borrow. The third consequence, I would like to talk about policy mix. So most of the policy actions or responses to the COVID-19 pandemic have focused on macroeconomic stabilization. But we don't know currently how large the supply and demand effects of the pandemic are, and as a result, what monetary and fiscal stimulus is needed or in fact is effective. So greater reliance on automatic stabilizers or policies that provide a safety net would reduce the need for stabilization during economic downturns or natural disasters, which New Zealand regularly experiences. So one such example is universal income. So universal income will provide a safety net, but it would also support structural adjustment and so increase the efficiency of the economy. Another example is recurrent taxes on immobile property. So if they were linked to property price movements, they would become an automatic stabilizer. This probably will require a new funding model for local governments, but which could also be designed to support reductions in inequality. With the emergency responses to the pandemic are passing, policies will need to shift from short-term responses to raising well-being long-term. There are several ways of achieving this by refocusing on sustainability, strengthening regional collaboration, so through free trade, labor mobility, harmonization with our Pacific neighbors, including high seas fishing, and also by progressing environmental objectives. Climate change is the most pressing issue of our time. So, for example, a regional carbon credit scheme could be developed for forestry and potentially for seaweed and algae. So the forest area in the Pacific, it's almost a third of the size of the Amazon forest, and the Pacific region controls 28% of the world's exclusive economic zone. The last consequence I would like to talk about is price signals. So prices give an allocation, give signals about the for the allocation of resources. But prices also very importantly signal potential imbalances in the economy. So if monetary and fiscal stimulus is above of what the economy can sustainably produce, this will raise inflation or inflation expectations. Also, rising debt may lead to higher inflation or higher inflation expectations if markets expect that authorities will try to inflate away the debt, when in fact that's what they're trying to do. Prices typically only adjust with the lag, and so measuring and monitoring inflation expectation is very important, which leads us to the second part of this presentation on a watching brief of inflation.
Thank you, Iris, and thank you very much to the organisers for putting together the program, and I very much appreciate the chance to speak. So, as Iris mentioned, I'll be talking about inflation. In particular, what I've done with my work is to estimate a daily time series of the inflation term structure, and I'll talk about what that means on the following slide. And the inflation term structure includes the inflation risk premium, and I'll talk about that on the subsequent slide. So doing this allows a timely monitoring of inflation expectations and inflation risk premium developments. And this is important in the current environment because it's essentially become a hot topic. Markets are getting a little bit more worried about the potential for higher inflation, particularly given some of the stimulus that's going on, both fiscal and monetary. And then we've got like the Biden stimulus plan in the US yet to feed through as well. And that has the potential of raising bond yields and undermine the value of stock markets. I've got some headlines on those things coming up later on, but that's the essential story. So the main takeaway is the graph that I've got at the bottom of the page here, and it's for the United States, and those results show that the COVID-induced angst about falling inflation that occurred immediately after the COVID crisis took hold has now more than reversed to above pre-COVID angst about rising inflation. So you can see the blue dot there about how low that inflation premium got, and I'll talk about that shortly, and then how high it's more recently risen. What is the inflation term structure? Well, you can basically think of it as being a plot of expectations about inflation by horizon or time to maturity. And what I've got as examples here is the United States in April 2020, shortly after the COVID crisis took hold and started becoming well noticed by authorities and markets. And so there's two ways you can think about the inflation term structure. One is the typical way that a survey question about inflation is asked. So in consensus forecast, which is the data that I use, they will ask survey participants, where do you think annual inflation will be in 1 year's time? Where do you think it'll be in 2 years' time, 3 years' time, 4 years' time, and on average, where do you think it'll be in 6 to 10 years' time, the average over that period? And so that would be how you plot those blue survey dots in the left-hand chart. Then there's these things called inflation swaps. And inflation swaps are not quite exactly the same thing as inflation expectations because they're a financial instrument and therefore they include a risk premium as well as the underlying inflation expectation. But the way that inflation swaps are traded is they'll say, essentially, where do you think inflation with that risk premium is going to average up to 1 year? What do you think the average is going to be up to the 2-year time to maturity, the 3-year time to maturity, etc.? And you can get these quotes in standard markets, the United States, the Euro area, and the UK, for example, going out from 1 to 30 years. Now, when people trade these inflation swaps, they're directly trading a view on inflation. So basically, someone will take a fixed rate of inflation that they are obliged to pay out to the other party, who will pay out to the fixed side what the realised rate of inflation or average rate of inflation was over the horizon of that contract. Now, obviously, that is going to be reasonably close to what people expect about inflation, but once again, there's going to be a risk premium embedded in inflation swaps that will account for the risk that you get from having a financial traded instrument. I should also say that, as far as I know, they are available in New Zealand as well. It's just that it's quite a bespoke market. So I worked in financial markets, and at the time, ANZ, for example, offered contracts on inflation that could be traded as an over-the-counter instrument. It's just that they're not, as far as I've found, available as standard quotes that I can take off a financial data page and run through my model. But hopefully, if I talk to the right people after this conference, maybe I can find some relevant New Zealand data and run that through to see what it says. What is the inflation risk premium? I've talked about it a little bit already. It's essentially the compensation that the person who takes the fixed leg of the inflation contract needs to get for taking on the risk that inflation, realised inflation, could go anywhere, and therefore they need to be compensated by the other side of the swap contract party to take that risk on. And mathematically, you can think of the inflation risk premium as essentially being, if we've got the survey term structure, we can compare that to the swap, the inflation swap term structure, and the difference between those is going to give us the risk premium. Now, that can be negative, as it was in April 2020 for the United States, if the market has got lots of angst about the potential for falling inflation, so lots of people want to speculate on inflation going lower or hedge themselves against lower inflation rates, therefore they'll chase that market and you can get a negative risk premium. At the moment, the risk premium is positive, and that means that people essentially have more angst about the potential for rising inflation, and therefore to hedge that, you've got to pay a premium, or people will only accept the fixed side of an inflation swap contract if you give them a premium to take that risk on. And so examples of what I'll abbreviate to positive inflation angst in words, and these are all just headlines from February, just past. Larry Summers warned about the potential for the Biden stimulus to lead to inflation, among other things. The economists have got their Inflategate. Bloomberg quite handily introduced me to the term inflation angst, and quite handily my partner Iris told me how to pronounce it in the German, proper German way. It actually means fear when you translate it directly into English, but I think you'll agree with me that angst carries more gravitas to it than fear. So that's why I use it. And that could rewrite the stock market playbook, as I mentioned before. If bond rates go higher and stock markets have been predicated on valuations based on those low bond rates, the stock market values could get undermined. CNN had an article on that just recently as well. Here in New Zealand, our very own Stephen Joyce warned that the COVID stimulus party risks waking the inflationary bear, and another well-known columnist in New Zealand, Bernard Hickey, also warned about something similar. So essentially you can think of my model as both tracking inflation expectations, and with that risk premium that gets tracked as well, that quantifies and helps track the inflation angst that the market has currently built into well, both markets and then wider financial markets as well. So what are the consequences of inflation and the inflation risk premium? I won't go through in any detail at all about the consequences of excessive inflation if it happens to get realised, because in a room full of economists or even non-economists, basically anyone who lived through the 70s or into the mid-80s, or can even remember that if you're a student, then you know that excessive inflation is bad news generally for an economy. What I do want to stress is that even angst about inflation does have consequences, and those consequences come through in real time. So if you think about a nominal bond rate, that the government issues bonds at, so essentially borrows from the market at, or a nominal interest rate that, say, a mortgage holder pays for a loan from the bank. You can think of those nominal rates as being composed of 4 components. Firstly, there will be, where do you think the real short-term interest rate is going to average from now up until the time to maturity of that loan or bond? Where do you think inflation is going to average from now up to the maturity of that loan? And where are the risk premiums currently on the real interest rates, and where are the risk premiums currently on the inflation component of those nominal interest rates? And that's the bit that I've highlighted in red there right at the end. Now, if you calculate from nominal bond rates what ex ante real interest rates are, you simply take the expectation of average inflation away from your nominal interest rate. That's what I've got in those formulas there. There's nothing very complicated at all. And what you get left with is 3 components. Your expected real short-term interest rate on average, your risk premium on real interest rates, and your risk premium on inflation, the red term that I've got right at the end of that bottom equation. And this shows that if there's positive angst about inflation, that will lead to higher ex-ante real-term interest rates. And real-term interest rates, or real interest rates in general, is what provides the economic incentive for an economic activity. So you can get higher real-term interest rates simply through people being worried about inflation. So the summary of my framework and its estimation, it all became very colourful, and I'm going to abbreviate it by saying I colour-coded what other people had previously done, and then how I had done sort of everything and put it all together, with the green part saying that I had done it on a daily basis. That means it's handier because we can track it more frequently if we need to. But I will skip to the chase by saying, and this is going to be a great headline if anyone wants to put it in the media, what I've done is an arbitrage-free Nelson-Segal model estimated with the Kelman filter using inflation survey and daily inflation swap data. So that'll fit nicely across the top of the Waikato Times. But more easily, I think, I've just basically taken my yield curve modelling that I've done on interest rates and I've applied it to inflation data. The result is that I get, as I mentioned right at the start, a daily inflation expectations term structure, and that also includes the daily risk premium on inflation as well, that inflation angst that we can keep an eye on. I've got that already for the United States. I've showed you the graph on that. I've got it for the Euro area in the UK because the data is standardly available. For New Zealand, I'll use my best endeavours to see if I can track down that data and run it through the same model and show you what it looks like. So I'll wrap up there by saying, in conclusion for both Iris and I, the COVID-19 pandemic has led to unprecedented policy actions. It's an uncertainty shock, and therefore we don't know how long it's going to last and how it already may have or will change the structure of the economy, and therefore we don't necessarily know even now what the appropriate policy actions are or how effective they might be. So we've got to keep in mind that this is an uncertainty, and it's uncertain the way that we should deal with it. We've done a pretty good job up till now, but we've still got more learning and testing perhaps to do. In terms of inflation, market prices give signals about potential imbalances, and so monitoring inflation expectations is important. And as I've talked about with the inflation risk premium, we need to be aware of inflation fear, the angst about rising inflation. And of course, this guy from the 1930s had plenty to say about fear or fear itself. I wasn't there, so I don't know exactly what he said. So I'll leave it there. And if we're very lucky, we might actually get an animation of what the evolution of the inflation expectations and the inflation risk premium for the United States looks like over time. I don't need to commentate this, so we can go straight into questions if you'd like while people watch.
Thank you very much for those presentations. Any questions from the floor? Is there one over there? Oh. Perhaps while we're getting the mic over there, I'll ask you one that ties in with the previous presentation. Looking at John McDermott's model results earlier, we will be in for an extended period of low interest rates and inflation. Is inflation dead?
Iris, would you like? I can offer some immediate comments and say, if you look at the current environment with very strong fiscal stimulus and monetary stimulus and, say, supply disruptions on things that we import from around the world, or generally what the world imports and exports all around the world in various economies, and the international labour market disinflationary force receding. It was very large in the 90s and sort of 2000s. We've probably got the best environment for an increase in inflation now that we had compared to the 1970s. Whether that will be realised is the key question. That's why we have to keep an eye on it.
Interesting insight after that discussion this morning on deflation. Should we go over to you, Eric?
Great, thanks. Interesting stuff. I love watching those graphs. It's great. It'll be neat to see the New Zealand version. A bit of a question for Iris. You'd mentioned potentially a UBI as counter-cyclical somehow, or providing some stabilization. Early on in this, Richard Mead and I had both come up with a fairly similar alternative, opening up the student loan scheme to non-students in really weird emergency circumstances like this. It seems a way of targeting things a little bit more focused manner. We know that the trade-off's always between a UBI and more focused supporter, that you can never give quite as much as to those who really need it under a UBI as compared to more targeted aid. I was wondering whether you'd compared alternatives like loan schemes that can be repaid and then mean that the government can extend a lot more aid as compared to a UBI. I note that Richard's work's recently published.
Yeah, there's always trade-offs between having a universal policy and one that is more targeted. So if you can target policies, they tend to be more effective and cheaper. But on the other hand, having targeted policies also don't always lead to the outcome that you're trying to achieve, because you might not always be able to target. So I would encourage, I haven't looked at any alternative policies. Universal income is one that I think has got appeals on several grounds. Whether or not it is achievable to implement, I don't know. But look at other policies. There's other automatic stabilizers that you can think about that are worthwhile considering. In terms of the previous question about whether inflation is dead, inflation is never dead, and that's why we need to keep on watching out for inflation and make sure that it does not come back, not become complacent.
Thank you very much. Any last questions from the floor? I'm going to ask one brief one that's come through here. It's tied in with the question that was asked this morning. The US stimulus package is huge, the current one. How concerned should we be about those spillover macro effects in New Zealand?
When it comes to United States financial markets, they really are the key driver of New Zealand financial markets. We've seen that with New Zealand bond rates going up quite rapidly just over recent months, and that's very much in line with the increase in US bond rates. And in turn, some of that is the inflation angst that I talked about in the United States. So I think the policy response they've got in the United States is, like better heads than me, have thought it's the correct thing to do, and that's fine. But they just need to be aware that if it looks like it's too much, they have to be aware that at some stage to put on the brakes. The Federal Reserve have said they'll allow inflation rates to go higher than their target to sort of average things out. One of the questions I asked of the Governor this morning, which I didn't really expect an answer, but it was a bit of a cheeky question: how much higher are central banks going to be comfortable with inflation being above target, and for how long? We don't know. And so at some stage, if it looks like inflation is pushing a bit higher, they may have to put on the brakes.
And let's leave on that note that we have to be careful in overachieving with our policy impacts. Thank you very much, both of you, for those excellent presentations and insights.
Thank you.